Mutual funds have witnessed a remarkable surge in popularity as an investment choice in India in recent decades. As per recent reports from AMFI, the total money managed by mutual funds have crossed rupees 46 lakh crores with more than six-fold increase in 10 years, thanks to the increased awareness of mutual funds and all the influences. But there is a question that often comes to our mind. How secure are mutual funds? Is there a risk of losing our money completely? What are the regulations in place that govern these mutual funds? In this video, we will see how mutual funds have evolved and how the regulation put forth by SEBI are benefiting the commoners. Let's explore. Welcome to holisticinvestment.in. First, let us look at the glimpse of evolution of mutual funds. There are 5 phases. First phase, 1964 to 1986. The mutual fund industry in India began in the year 1963 when UTI, Unit Trust of India, was established. UTI introduced its first scheme called Unit Scheme 1964 by the end of 1988. UTI managed assets worth rupees 6,700 crores. Second phase, 1987 to 1993. In the year 1987, public sector mutual funds initiated by public sector banks, Life Insurance Corporation of India, General Insurance Corporation of India entered the scene. SBI Mutual Fund was the pioneer starting in June 1987, followed by Can Bank Mutual Fund in the year 1987. LIC introduced its mutual fund scheme in the year 1989. Third phase, 1993 to 2003. In April 1992, SEBI was created to safeguard investors' interest, to promote market development and to regulate the securities market. Kothari Pioneer, which has since merged with the Franklin Templeton Mutual Fund, became the first private sector mutual fund. The comprehensive SEBI Mutual Fund Regulation 1996 came into effect, which is still applicable. Fourth phase, February 2003 to April 2014. In February 2003, UTI underwent a division into 2 distinct entities. The Specified Unit Trust of India operated independently of mutual fund regulations and was under the exclusive management of the government. UTI mutual funds sponsored by SBI, LIC, PNB and BOB emerged. And final, fifth phase, that is the current phase. Since May 2014, more initiatives were brought to people, thereby building trust. These initiatives were aimed to revitalize the Indian mutual fund industry and enhance its reach. Over time, these measures effectively reversed the adverse trajectory that had emerged following the global economic downturn in 2008. Now let us look how is mutual fund constructed in India. It operates with 3-tier structure. There is the sponsor, the trust and the asset management company. The goal is to ensure that neither the sponsor nor the AMC can run off with our money. First, trust. The funds are held by the trustee company or a board of trustees. The trust rules in India are strict. Next, sponsors. They set up the mutual fund business to make profit. For example, South Korean Mirai Asset Global Investment Company Limited is the sponsor for Mirai Asset Management Company. Next, AMC. The sponsors create a company to manage the funds, which is called the Asset Management Company. This AMC is essentially the mutual fund itself. The AMC charges a fee for its service and the money from investor is held by the trustee company. This money is then invested in various things like stocks, bonds, gold and other assets allowed by the regulator. As mutual fund investors, we should understand this structure to know that our money is safe from someone running away with it. Thankfully, in the history of regulated mutual funds in India, there hasn't been a case of mutual fund AMC running off with investors' money. Next, we shall look at the path to fraud-resilient mutual fund industry. SEBI, since its inception in 1993, took over the responsibility of building a robust system for retail investors. Let us look in detail at how SEBI made this a foolproof system safeguarding our money. 2006, abolition of high agent commission and NFO fees. Before 2006, mutual funds were allowed to charge investors a substantial 6% of their investment in marketing and distribution costs for new fund offers. Additionally, there was an upfront charge of 2.25% for every mutual fund scheme purchased. So all put together, the total agent commission was around 9%. This practice resulted in investors not only losing money due to the hefty commission, but also contributed to a churn scam. They encouraged frequent buying and selling of these funds primarily to reap the benefit of these commissions for themselves. Abolition of these fees and commission helped the investor to invest at a lower cost and stopped the churn in the portfolio. The asset under management in mutual fund industry increased from 3.23 trillion in late 2006 to 4.13 trillion by the end of 2008. Next, in the year 2009, SEBI removes the upfront commission. This front load fee was in addition to the expense ratio that the AMC levied on the investor. As a result, SEBI made the Indian mutual funds for the first in the world to become no load funds. The industry reacted negatively as the AUM dipped after this announcement. However, the inflow quickly rebounded and moved to abolish the upfront commission paid off. Next, 2013, the birth of direct mutual funds. Starting from January 1, 2013, investor had the option to bypass agents and invest directly in mutual fund schemes. These changes benefited investors by avoiding trail commissions to agents. Only if the client's portfolio grows, the agent's incentive will grow. This change aligned the interest of distributors more closely with those of investors, promoting a culture of responsible financial planning and genuine wealth building opportunities. All the regulations that the SEBI had put in only eased investing and increased the overall AUM of the funds. By the end of 2018, the asset under management had reached 22.86 trillion. 2019, trimming down expense ratios. The expense ratio is the percentage that denotes the amount of money you are paying to the AMC as a fee to manage your investments. In other words, it is the per unit cost for running and managing the mutual fund. As mutual fund grow, their fixed cost tend to remain relatively constant. Logically, this should result in a noticeable decrease in expense ratio for large funds. However, SEBI noticed that the expense ratios were either kept unchanged or were increasing. In yet another cost reduction, SEBI fixed an expense ratio of 1.05% for equity schemes with assets exceeding rupees 50,000 crores and 0.80% for debt funds. As the AUM grows, the total expense ratio is bound to be reduced as shown in the chart. The advantage of this reduction in total expense ratio was manifold and lead to the following benefits: lower cost, improved returns and transparency. The overall AUM saw an upward trajectory and the total AUM rose to 26.54 trillion by the end of 2019. Next, in the year 2020, categorizing mutual funds. In the year 2020, SEBI grouped the mutual funds into 36 different categories, each with specific rules on what they could invest in. They did this by cutting down on the number of categories, telling funds what they could put in each category and making sure each company had only one scheme per category. This also helped the investors to understand each category's risk and the type of stock the funds would invest in. The AUM at the end of 2020 was 31.02 trillion. Introduction of riskometer. The riskometer is like a visual indicator that shows you the level of risk linked to a specific mutual fund scheme. It usually has 5 levels: low, substantially low, moderate, moderately high and high. It acts as a guide, helping you to assess the fund's risk level and see if they align with your risk tolerance. Next, we are moving to important topic: insurance policy regulation versus mutual fund regulations. Have you ever received any calls from agents persuading you to buy ULIP policies? Have you ever found yourself with ULIP and the same agent calls you again promoting a different plan to convince you to invest in it by withdrawing the earlier invested ULIP? The answer without any deliberation is a definite yes. On the other hand, have you ever received a call from any mutual fund distributor? Well, the answer is no, or comparatively less. This is because there is no forced selling in mutual funds, unlike in insurance policies. When you buy an insurance policy, a substantial portion of your initial payment often goes towards commission to the agent, whereas mutual funds are more cost-effective option for investors as they have done away with the front-loading charges. Plus, mutual funds typically don't have entry fees. Their exit fees are comparatively low, especially if you are investing for a short-term. This means you can switch between funds if you realize you made the wrong choice initially. ULIPs still have those front loading charges and a variety of fees, including entry, exit fee. Switching between ULIPs isn't as straightforward, making mutual funds more investor friendly choice. Mutual funds reward distributors based on performance, ensuring their interests are in sync with the investor who seek portfolio growth. In contrast, ULIPs generally lack performance based incentives for agents. Mutual funds benefits from SEBI's categorization rules, which standardize product categories and investment objective, offering investors clarity about their investment choice. For instance, a large cap fund from ICICI and a large cap from SBI can be compared to each other since they have the same style of investing. ULIPs lack standardized categorization because there are no common benchmarks to compare them. Here is our conclusion. In the grand scheme of things, mutual funds have become a win-win situation for all the stakeholders, the investors, the mutual fund distributors, and the financial industry as a whole. It is an investment avenue where your financial well-being is prioritized over hidden fees and commissions. It promotes trust, transparency, and responsible financial planning, ensuring that the sector continues to grow and thrive while providing investors with genuine opportunities to build their wealth. So, choose the right fund, keep investing for the long term, and mutual funds will help you reap the benefits. A detailed blog post on this topic is available in our website, and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.